our banks. Let's discuss this with Rady, CEO and Portfolio Manager of Rady Asset Management, and David Ellison, Chief Investment Officer of the FBR Funds. Welcome to the program, gentlemen. And Harry, let's kick things off with you. You know, we have heard that the banks are not going to fail, regardless of what these test results are. At least that's been the party line from the administration. So why would we be concerned about the potential of their need to raise capital beyond being concerned as a shareholder of these companies?
Yeah, that's a very good question. You know, I've had the opportunity during my career to serve on the board of directors of a number of publicly traded financial institutions. And during my time on those boards, we actually went through similar stress tests. And I have a couple of concerns. The first one is a number of these regulators don't have the big picture business judgment, and they rely too heavily on quantitative metrics. And that concerns me. The other thing that I think is important for investors to take into account is that there's an inherent conflict of interest between the regulators, shareholders, and management. The regulator's job is to make sure they avoid an insolvency and to keep the flow of capital going. But they're doing nothing to protect the interest of shareholders. So I think that's really important for people to take into account.
And David, with that interest of shareholders in question, if these banks have to go out to the market and raise capital, one of the questions is going to be at what price is the market willing to pay?
Well, I think this is a data point that we're getting from the government. Remember, they've been looking at these companies for 4 or 5 months. They probably have a tremendous amount of inside information in the sense that we can't get as analysts, and they're telling us that basically conditions in the industry aren't a lot worse than what we expected in terms of all these stress tests that have been done by Wall Street and so on and so forth. But I think in terms of the shareholders, again, you know, we know what the book values are, we know what the capital ratios need to be. We can make our own judgment on these things, and I think that's what the market is doing right now.
And Harry has made his own judgment. Tell us about how you've positioned yourself ahead of these stress tests, and what, if anything, comes out on May 4th that will make you change that position?
You know, we've been short Northern Trust, and we're thinking about covering it given the decline in the stock price. But given the volatility in the space, I just think that there's too much uncertainty, and I don't think there's a lot of opportunity, certainly on the long side. We're starting to see opportunity on the short side, and that's where we're spending most of our time. But this volatility is just very, very difficult and very dangerous. So we've got relatively high cash positions, and we're steering clear of this space.
David, I know you can't address specific stocks, but you have been building your position in financials.
Yes, I've had, you know, the last 2 years or so, I've had, you know, a tremendous amount of cash in my portfolios, and I've been whittling that down. And because basically I'm seeing the conditions are turning in the sense that today, for example, consumer confidence is a little better. We're hearing that in California, home sales are up. The median prices are up a little bit. You know, LIBOR has come down the last 3 or 4 months. You know, financial institutions have access to capital. And I think that, you know, the industry is starting to basically, you know, all hands are on deck to get things better.
And there's certainly a question of how things will get better and whether or not the current management will be there. Harry, what do you expect to come out of Bank of America's meeting tomorrow? Do you think Ken Lewis will still be on board after that meeting, and should he be?
Well, I'd just like to respond to the prior guest statement that things are improving. I personally believe that this is a head fake, and that these improvements that we're seeing are just squiggles on a graph. And, you know, I'll give you an example. There's about a 1-year supply of housing inventory that's currently on the market. There's probably another year of phantom inventory on the bank's balance sheets. In order for the housing market to function normally, there should be about 3 months of inventory. So 2 years worth of inventory, I just have a really difficult time seeing how things are going to get better anytime soon.
How about over at Bank of America, Ken Lewis, it's going to be the big hot button issue of tomorrow. Is he in or is he out?
There's no way to know. I mean, I think that...
David, how about you? Do you know?
I haven't heard anything. I don't see any reason why you would take a guy, you know, out of a position that's doing a reasonably decent job given the conditions in the industry.
All right, Harry and David, thanks so much for being with us today.
Thanks for having me.
So what do you think?